I think we're ready to go. Hello, everyone, and welcome to today's session. Thank you for investing your time with us today. My name is Josh Rogove, and I'm the president of CR Solutions, a third-party WrapUp administration firm. Today, we have an amazing panel on GLOnly WrapUp Insurance Made Simple, where we'll be talking about the ease and affordability of using GLOnly WrapUp programs and lessons learned from our panelists that guarantee best outcomes. Our panelists today are Nick Cott from Parker Smith & Feek. Parker Smith & Feek is a broker out in Washington State, which is a monopolistic state. So obviously, because of that, Nick has extensive experience with GLOnlys. Our second panelist today is Tanya Santry from Fisher Harris & Shapiro. Fisher Harris Shapiro is a consultant based here in New York City. With Tanya as a panelist, we bring the unique experience of her work today on consulting more on the owner side, but also her prior experience. She was a risk manager for a multinational construction firm where she handled the CSIP for that company. And then last but not least, we have our very own Leah Stewart from CR Solutions. Leah is based in our Alpharetta office. She heads up our GLOnly group, and her and her team are currently managing over 100 GLOnly projects. So we decided to organize this webinar based upon the increased popularity and demand for this product for all sizes of projects, as well as opportunistic market conditions. Here are some of today's topics we plan on covering. If anyone has any questions, feel free to send us an email and we will share questions and responses with all attendees. A recorded version of this webinar and the slides will also be emailed to you after the webinar. Let's get into it. So first slide is, what is a GLOnly WrapUp policy? So I'm going to start with the definition of a WrapUp. A WrapUp is a risk management and a financial product that provides greater control over construction exposures. The sponsor provides insurance coverage, loss control, and claims management on behalf of themselves, the general contractor, and all subs of every tier. In turn, each contractor is required to remove the cost of insurance from their contractor bid, and the result is a more efficient, cost-effective risk management program covering their project. So when I mentioned insurance coverage as part of the definition, obviously with the GLOnly WrapUp, we're only covering general liability and excess. Some common misinterpretations is when you say GLOnly, that does include excess. So the only line that's not included that would normally be covered under a byline WrapUp or full WrapUp is workers' compensation. So under these programs, general liability and excess is provided. Workers' comp is separate and outside, and it's still required to be maintained by the subcontractors. Another point on the GLOnly programs is that these can be either OSIPs or CSIPs. OSIP being owner-controlled insurance program, or CSIP is contractor-controlled insurance program. I think, Joanna, what slide are we on? No, go back 2 slides, sorry. Go down 1. Okay, so much like a byline or full WrapUp, no, keep going, sorry, next one. Much like a byline or full WrapUp, some of the reasons that GLOnly WrapUps are placed over traditional or project-specific coverage is greater control of insurance costs. So this way you get costs fixed for the term of the project. The limits, under these programs, the sponsor chooses how much coverage to buy. Quality and stability of the coverage. The sponsor chooses carriers that they want to insure their project, and safety and claims management. So under these programs, you're able to implement project-specific safety and claims management processes and procedures. And last but not least, like byline deals, it does promote MBE and WBE participation based on it taking insurance out of the equation to qualify subcontractors. So you essentially broaden the subcontractor pool eligible to bid these jobs. Next slide, please. So full wraps versus GLOnly and the differences. First, I just want to mention that throughout this webinar today, we're going to put New York aside. So currently, there are no markets that will write GLOnly WrapUps in New York, at least with any risk transfer. And also, the full WrapUp market with New York tends to be an outlier from the rest of the country. So we're going to assume that we're talking full wraps and GLOnlys, and more specific GLOnlys for all states except New York. So I'm going to mention 4 differences based on these programs. The first one is insurance markets. So typically full WrapUps are underwritten more by like the standard markets. more of the household names. What we see is usually there's 10 to 12 carriers that will play in that space, whereas the GL-onlys are underwritten more traditionally by the E&S carriers. That said, there are some standard markets that are trying to enter the market today, but I'd say majority of the deals we see are underwritten by E&S players. Second point or point of difference is distribution. So full wrap-ups are traditionally are distributed via a retail distribution. So a broker needs to be appointed with a specific carrier. They place the business there, and then they may use a wholesaler for the excess, but the primary is usually directly placed. Whereas the GL-onlys are more wholesale driven. So a retail broker would go to a wholesale broker, and that wholesale broker would access the E&S markets. Now, for the brokers on the line, I just did want to comment on compensation and how that does differ. So on full wrap-ups, there's typically no commission paid, or there's no commission paid on the primary placement. There is commission on the excess, but typically on full wrap-ups, the retailer charges a line item for their fees, and then they get excess commission. Whereas on the GL-onlys, which is wholesale driven, there's commission on the primary as well as the excess. Next point I wanted to discuss was program structure. So typically on the full wrap-ups or byline deals, these programs typically start with a large deductible, usually starting at around $250,000. And again, because the workers' comp is included in these programs, that deductible is typically required to be collateralized by letter of credit or cash. On these GL-only programs, we typically see a small deductible, usually starting at around $25,000, and there's no collateral typically required on these programs. And the last bullet is the motivations. So on full wrap-ups and GL-onlys, the motivations are for risk management and financial benefits. I would comment, though, that based upon the smaller deductible on the GL-onlys, the financial benefit is not as great as it would be on a byline deal where you have a larger retention. There are opportunities to save on the buy, so you could potentially buy a GL-only for less than or equal to what the amount of insurance is in the program, and we'll get into that later on. But with such a small deductible of $25,000, the variable cost component is a minimal cost. So driving savings out from controlling losses is less likely than it would be on a byline wrap-up. Next, we're going to talk about eligibility of projects that fit GL-onlys. So under full wrap-ups, what we usually say, and again, I'm excluding New York, you typically need about $100 million in hard cost construction value to qualify to do a wrap-up, or to qualify to do a wrap-up that makes financial sense, probably makes more sense. To do a GL-only, we've seen projects as small as $10 million. And in fact, on some rolling programs, we've seen even smaller size jobs. Just a couple of weeks ago, I actually received a call from someone that did find our name on Google. So our search engine optimization is working, which is a positive sign. But they had placed or was looking to place, actually had it placed and quoted, a GL-only wrap-up for $4 million. It was 8 homes, single family homes, each at $500,000, and they found a carrier willing to write it. So obviously with the smaller job size threshold, there's many more opportunities available to do GL-onlys versus byline deals. Last point I want to talk about is the different types of programs that you can have under these GL-onlys. And this is the same as under byline or full wrap-ups. You can do a project specific. So under the project specific, you would have a defined project location. You'd have limits, ideally reinstating annually. Once the project's put to its intended use, you'd have a dedicated completed operations tail. Or you could do what's called a rolling program, where, and much like many other insurance purchases, volume is power. So you essentially make a commitment of volume to an insurance carrier, and based on that volume commitment, you get preferred pricing or pricing that's, I guess, more preferred than it would be if you did a standalone project. And for these rolling programs, typically what the underwriting community wants is they'll allow you to start any new jobs over the next 24 to 30 months. So as long as they fit within the parameters that were initially set up, similar, like in kind, usually in similar jurisdictions, and those jobs can be replaced, but you're making a volume commitment. So all jobs that would start over 24 to 30 months, yet from the time that the first job starts to the last job is completed is typically a 5-year term. And the one area of concern I would say on these rolling programs is because of the fact that you're making a volume commitment. If you don't make that commitment, you're going to be penalized for that. So you're getting the concession of rate based on the volume commitment. So if you are going rolling, just be careful and be confident in the volume that you're willing to commit. So I've definitely said too much already. So we're going to jump into this with our panelists. Nick, as the broker on our panel, any placement differences between project-specific and rolling programs?
Yeah, great question, Josh. I would say nothing materially different. As you pointed out before, needing that volume to really drive a rolling program. But a single project versus rolling, you're not getting anything from a coverage form difference with the way that should be put together. A rolling program allows a sponsor to guarantee form and carrier panel consistency across all of your projects, which minimizes the amount of negotiation with the underwriting markets. And as you stated before, should allow you to derive some cost savings there. A rolling program would also allow you to utilize the same OSIP addendum and OSIP manual for each of your projects. However, your broker shouldn't be starting from scratch with those documents either. A broker that specializes in project risk should have proprietary documents on hand that they're creating for your projects. Not every owner is suited for a rolling program either. You need to have sufficient project volume in order to necessitate a rolling program. So the majority of the policies that we place are for single projects. And those seem to be well received within the underwriting market.
Great, thanks, Nick. Now, Leah, any differences from the administration side of rolling programs versus project specific?
Yeah, thanks, Josh. I would say from an administrative perspective, there aren't too many differences in what we would do on a project specific versus a rolling program. As Nick mentioned, there are going to be some efficiencies realized on a rolling program because you'll usually have one set of program documents. Some other efficiencies are you may receive some subsequent subcontractors and general contractors that have been involved in the program. So having, you wouldn't necessarily need to have a separate kickoff meeting for each of those projects. So you're condensing that content. I would also say that from an enrollment perspective, if you have subsequent and repeat subcontractors, really not having to have a subcontractor complete a brand new set of enrollment forms for each project is really going to create some efficiencies that can often lead to lower administrative costs for that program sponsor. And then I would just add from a coverage perspective that when the project is coming up for completion, if it were to need an extension on a project specific program, you're going to have to go to the carriers and negotiate those extensions. Whereas on a rolling program, as you mentioned, you have a longer term. So processing that extension from a coverage and administrative standpoint is going to be a lot more simple.
Great. Nick, how does the cost component of these programs work?
Yeah, I mean, I think as an owner, you're paying for the GL insurance for the project, either through the OSIP or via pass-through from the GC and subs and the GMP. So that's kind of the clarifying statement there, right? OSIP underwriters are viewing the projects on its merits as well as the GC's experience. So an individual project rate can often be more favorable than going through the traditional risk pass-through. And keep in mind, with the GMP, you're getting tax added on top, as well as likely some load from the GC for some override for their end. So when we go through this analysis with our clients, often very early in the pro forma stages of a project, determining whether it's going to be a go or no go, we can, really put pen to pencil there and paper and figure out a number that makes sense and was within reason for a client to go forward with from a budgetary standpoint there. They often end up being about the same.
Great, thank you, Nick. So Tanya, now that we've talked about some costs, what are the risk management benefits of these programs?
So I think when we look at this slide, a lot of these points have been mentioned by Josh already, but I feel that it is kind of important to actually go back and recap them again. So, we talked about dedicated limits. Dedicated limits, again, it's going to be limits dedicated to the project. You're not going to have to worry about sharing the limits with any other projects or claims being eroded from other projects. Higher limits, border coverage. This allows the owner to decide on the limits of insurance that they want to purchase to make sure it is adequate and they're comfortable for the project, as well as it satisfies any lender request. Also, they're going to be able to design the coverage. So this is going to basically, when you take these 2 points together, which are very important, you're going to make sure that if you need insurance, the insurance is going to be there for you. It also is going to alleviate any concerns over possible exclusions when you rely on a general contractor's policy or any other party's policies, as well as, what type of additional insured endorsement do you have? Do you have one that is broader, or do you have one that's more restrictive? It's also going to be set up as one program. It's one primary policy that is going to be covering the owner, the GC, and all the enrolled subcontractors. So that again eliminates who's at fault. Take that old saying, it eliminates the finger pointing. But what I think is really important about all these benefits that we're kind of highlighting with this GLOnly wrap-up is that it comes with very low retention. So you're not really investing financially either. So again, as Josh said, you're typically looking at deductibles that are either $25,000 or $50,000. So it really makes it, to me, a little bit more attractive. And again, as an owner, it allows you, to take control of the project and manage risk.
Great, thanks, Tanya. Now, based on today's environment, I don't think we can get through this without really talking about COVID. Nick, anything you could add based on the recent COVID concerns? How does this product help, or if you can talk us through that?
Yeah, I think there's certainly some challenges. An owner having control over an OSIP allows for them to be more interactive in the conversation with underwriters about extensions that are being needed for projects across the country. I think a traditional GC program is probably going to provide some of those same benefits, but just having that direct line of communication as a project sponsor for a WRAP program, as opposed to the traditional risk pass-through, does provide some more flexibility for a sponsor.
Great. So Nick, let's also discuss how the GLOnly wrap-up affects the owner, contractor, and project.
Yeah, I think, again, with an OSIP, you're taking control over program design and administration for a single policy. So you're getting to determine project-specific limits, and perhaps most importantly, you're ensuring those consistent coverage limits through the statute of repose for a project, which is really critical. Again, you look at what is the next 5 years going to look like as we bounce back as an economy, and are all of those subs that are working on your projects now still going to be in business and still going to be able to provide that same level of coverage that they're committing to now or they had committed to previously when starting the project. Another huge benefit is that unified defense. So in the event of loss, damage, or a claim made against the policy, you do have a unified defense for everybody that's involved. So you're not dealing with multiple insurance companies, you're not dealing with multiple attorneys, multiple independent adjusters. So it really streamlines that process. When people think about insurance, they do think about the claim, and it can often be a headache. And this is one way that headache can be avoided. For a contractor, their program's protected. It might be a project that is not really in their bailiwick and that they're making a bit of a reach on, or it might be a project that has some really unique components to it that do expose it more to a GL claim than a typical project would for them. So their program is protected, their deductible is protected. Oftentimes we do find that a GC is very comfortable with an owner, kind of taking over the coverage for a project.
Great. And anything you'd add regarding the effect of this product on project financing? Yeah,
obviously that's a big component for a go, no go for a project of, when a client is going to have the funds to pay for that coverage. It can often be easier for a client to do that through their first loan draw to pay off the GMP, or through a series of loan draws as a project goes on and paying the GMP. We often work with our clients on getting finance agreements in place that allowed for deferred payments or small down payments on a program, and then stretching out those payments over, be it 12 months, 18 months, even as long as 24 months in some cases for larger projects. So that really does provide that program sponsor with some real flexibility and cash flow management as they enter into a project.
Great, thank you. So Tanya, aside from control of coverage and costs, what are some of the other benefits?
There are definitely some benefits under a GLOnly wrap-up program, and I think the named insured coverage that's available to me is a very important one. There's a clear distinction between a named insured and an additional insured. And when you're a named insured, that's basically, it's going to be your own insurance, and there's going to be coverage there for you unless it's excluded by the policy. When you're an additional insured, it's someone else's insurance, and you're basically expecting to be afforded coverage under that policy, but that's not always the case. And I think sometimes entities, that potentially are additional insured only, need to realize that there are limitations that come along with that when they don't have their own insurance. And, if we keep with the owner GC relationship, as an owner, is the GC responsible for the claim? Is it something to do with their construction operations? Additional insured endorsement, again, is it burden coverage or is it restriction coverage? And that could potentially determine how you're picked up as the additional insured. Is the GC policy in force? Have they paid their premiums? Are they still in business 3 to 5 years after the project completes and, as an owner, you have a claim? You assume once you start the project and you look at a general contractor and they might be very strong in their financials and been in business for years, but then, you look at COVID and kind of what it did to, the construction industry, and can't kind of predict those things. So those are some things you should just think of, just if you were going to go down the route of being an additional insured only. Also, an owner's practice policy typically has exclusions for construction, as those carriers are expecting that you do have insurance elsewhere. So I think the GL-only wrap-up for an owner is a really great, again, product that will provide them named insured status, will enable them to have their own insurance and not build a construction project as an additional insured under a GC's policy, which I have seen all the more too frequently. It also will alleviate the necessity for an owner to have to go out and purchase an owner's interest, which obviously is another way they can provide their own insurance in addition to the GC, but that is, again, just another added cost. And, in working in the market of recent, I really see a definite lack of knowledge surrounding this. And just, you don't want to be in a position where if you have a claim, you don't have insurance.
Good stuff. So once the project's been put to its intended use under these programs, how does coverage apply under these GL-only wrap-ups?
So when I look at this slide, I'm going to kind of take the fewer worries and the completed operations together, because I kind of feel, the completed operations is kind of what gives you fewer worries post-construction. So under GL-only wrap-up, you're going to have a completed operations extension period. It's going to provide you coverage for claims arising out of the construction that happen after the project ends. And it will typically either be the statute of repose or 10 years, whichever is the lesser. So again, when you have this own tail and it's your own coverage, again, as an owner, you don't have to worry about the GC being in business. You don't have to worry about GC still having the limits. You don't have to worry about maybe they have different insurance or, things have changed in their policy or there's an exclusion. So you also actually, you don't have to chase the GC down. So there's a lot of good things that happen under the GL-only wrap-up with the post-construction stuff. The other thing I do want to mention is the limited repair endorsement. I've seen this years ago really only on California condominiums, and it kind of started there, with the premise that, subcontractors didn't have insurance to build residential. So this kind of gave that extra coverage after the project ended, should a subcontractor need to come back. I see it more and more often on the GL-only wrap-up, regardless of the state, regardless if it's residential or commercial. And again, it's an added benefit. I would say you should probably review the endorsement. Many of the endorsements vary as far as how they define that work that's included in it and like what a subcontractor can come back and do after the project ends.
Great, thank you. Now, Tanya, I'm going to ask you to go back in time, take off your consultant hat, and kind of use your experience more when you were on the GC side, because I want to talk more about OSIP versus CSIP and controlling the placement. What are the reasons to let the GC provide the coverage under a CSIP?
Well, my other hat would say probably all the time, but that would relate to a full-blown wrap, which is not the conversation today. But look, I think when it comes to GL-only wrap-up, what I've seen is that I don't see the underwriting market differentiate on how they look at the risk from an underwriting perspective, where I think the full-blown wrap-ups, they looked at OSIP and CSIP very different, and in the more recent times, CSIP became, more popular and easier than placing an OSIP. So, I mean, the process is kind of the same. You touched upon it a little earlier with, it's the E&S market. It's a application you will unfortunately have to complete. It's going to ask the same information basically about the project. It's going to have information on your GC. It's going to request loss runs. So that process doesn't change. So I don't think there's much difference. So what I would say on why you would let the GC potentially handle it in the GLOnly is, look, assuming no coverage, no limits different, you know, apples to apples from that standpoint. Look, a GC could have more competitive rates through a rolling program. So you might want to take advantage of that from a cost perspective. They could have lower deductibles. That's also something else you could possibly take advantage of. Also, if you are doing an OSIP, you would need to pay your premiums up front. You know, although Nick did talk about the premium finance options, where I have seen some of my clients, you know, kind of negotiate some type of payment plan with the GC when they're using their program, mostly when it's some type of rolling program. So, I mean, those would be some more or less the financial reasons. The other thing I will say that's not on this slide, the other thing an owner should consider in an OSIP is, yes, there is going to be some administration involved. Leah is going to go into that later on, but it's definitely not the level of involvement with a full-blown wrap-up. But, you know, they do have to be able to be involved somewhat to the administration, the claims handling, and things of that nature that, you know, obviously if a contractor does it through a CSIP, it would be less burden on them.
Great. So Nick, switching gears to doing an OSIP over CSIP. If the owner does choose to provide the coverage, should you expect resistance from the GC?
Yeah, I think that's often something that we do see. I mean, you know, dovetailing to what Tanya said, the initial perception is it's going to be more work for me as a GC. And a lot of that initial reaction is based on past experience, you know, and I think that's true for most GCs, is that they've had some good experience with an OSIP or they've had a poor experience with an OSIP, and even in varies from project manager to project manager. So I think there's always going to be a little bit of reluctance met initially when an owner says, we're thinking about going OSIP, especially if you're not exploring that early in the contract and kind of budgeting process with the GC. The GC really wants to know that there's going to be sufficient coverage being provided, and they're going to want input on that bid credit process based on what's worked for them on past OSIPs and what works for their bid process with subs. I mean, oftentimes they're out to those initial subs months in advance of a GMP being finalized. So they're having to pivot on that, which anytime anybody receives something as more work or perceives something as more work, it's going to be met with some reluctance. And ultimately, the GC needs to feel that there's not going to be more work for them, and there's not going to be an administrative burden on them or their key subs. You know, we try to really minimize that. You know, in that first few weeks of a program getting up and running is really where we need that engagement from the GC, and then after that, it's a few calls, you know, every few months to kind of keep the program up and running. But it's that kind of key kickoff phase that really alleviates concerns. But you need to be working with a broker who has, you know, a tried and tested process and can walk you and your GC through that process and really carry the administrative burden for both parties and take ownership of that. And working with the right administrator who makes the enrollment process easy for the GCs and subs, provides regular enrollment reports so that the GC feels like their administrative portion of the you know, process and getting their subs on board and on the project site timely and keeping the project, you know, running you know, per their timeline is being facilitated by somebody else.
Great. So we talked about a lot of the positives. Are there any downsides to the owner by choosing to go OSIP?
Yeah, I think, again, a bit more administrative work from the onset. You know, it's certainly more work than allowing the GC to provide the coverage. With that, it's, you know, it can become more difficult to negotiate extensions with underwriters, especially as reinsurance terms tighten. You know, you could be looking at sometimes additional premium near the end, especially if you're, you know, well over budget. So a lot of that comes into negotiations at the time of placing the coverage. And again, working with somebody who understands the markets and understands how to put this unique program together in a way that really works for the owner. But, you know, one of the things I said is, again, like in the event of a claim, which is really where you want the insurance coverage to be there and having your back, that's where as an owner, you're going to want to have control over that process instead of turning that process over. So yeah, are there some drawbacks? Yes, but there's absolutely positives that outweigh those drawbacks, from the consistency of the coverage, oftentimes broader coverage, and then just knowing that that coverage is going to be there through that statute of repose.
Great, thank you. And just staying with you, Nick, too, I mean, this is a question I get all the time. I'm sure you hear it as well. If, as a sponsor, if I do decide to go forward, what are my roles and responsibilities? Is this going to be more work for my organization? Am I going to need to staff up for this? Anything you can add to that?
Yeah, again, kind of based on my previous statements, there's slightly more work on the front end than the traditional risk pass-through. I mean, utilizing an OSIP requires additional applications to facilitate the underwriting process, the creation of an addendum and a manual to go with your construction contract. But the OSIP allows you to, potentially avoid unforeseen issues through the traditional pass-through approach as well. One of the things that Tanya talked about, was contractor and subcontractor insolvency, and there can be insurer insolvency that we might be looking at, in the future as well. You never know who a subcontractor or a smaller, trade contractor is with. And even based on the size of their contract, they could be a critical component of whether or not you're going to have construction defect on that project. You're also avoiding partial or contributory negligence discussions or arguments or suits by, again, having just one policy. One of the things, Josh, you touched on early was a reinstatement of limits. So oftentimes if the project's long enough, we're able to negotiate a reinstatement of that general ag limit, which allows you to avoid inadequate or eroded limits. Again, I think there are some challenges from the onset, but all of the benefits in the long run outweigh those, small administrative commitments in the month leading up to the kickoff of the project.
Great, thank you. So Leah, I don't want to wake you up. I know I left you alone, but you're up now. Who are the players under this wrap-up scenario?
Yeah, so I would say the first thing you need is a good broker. So a broker should be able to guide you through the process from the beginning to the end and highlight the roles and responsibilities of all involved and how they and their team are going to alleviate any undue burden on you as the program sponsor. The broker should be able to demonstrate other projects that they've placed under OSIPs for similar situations, and they should have good references that can speak to their expertise about their previous placements.
Right. Nick, as the broker in the room, anything you'd add?
Yeah, I think, making sure that you're completing that pro forma and the cost analysis early in the process and really understanding what the impact of the OSIP can be for you through, the bid credit process there as well is really something that I think is critical in the decision-making process early on, and selecting, again, whether this is going to be a path forward for you or something that was just an interesting, financial exercise to help you better understand and firm up the decisions that you're making about the project.
Thank you. And Tanya, although a consultant's not always involved, when there is a consultant involved, anything you'd add?
Look, from the consultant point of view, like you said, we're obviously, there's 3 partners up there, and if you have a GLOnly wrap-up, you're always going to have a broker and you're always going to have an administrator. But where I think a consultant can bring value, being new to the consultant role, I think we can offer some expertise in that we are dealing with many brokers. We have many clients across our portfolio, so it kind of gives us, a broad range of what's going on in the market, and allows us to recommend additional markets because now we've seen it on another account, or coverage improvements because, I did work with this broker and they were able to negotiate this on behalf of their client. So I think some of those things just kind of help give a next set of level of eyes to actually assist the broker, again, because, we're not lined up with one broker. We're really not lined up with one client. And we're working with, all different types of clients and brokers across the US. The other thing I think too, as an independent party, we can offer financial analysis to anything to obviously see if it makes sense, especially in, the GLOnly wrap-up. We can kind of give insight as to what we're seeing as far as, you know, yeah, that's a good rate, or now we think that's expensive, or in comparison to the, you know, GC costs and pricing and owner interest. So again, I think we can kind of bring a little bit broader view, you know, not being, you know, tied specifically to a project, because we work with other projects and other clients.
Thank you. So Leah, back to you. From your experience, how do we ensure success?
So there's a few things I believe that should be done to ensure success. And Nick touched on one of these earlier, which is start early. The earlier you engage your broker and your administrator, the better and more smoothly things are going to go for all participants. Getting started early initiates the production of the program document. So a good administrator will help you prepare an instructions to bidders to get out to your general contractor and your subcontractors. It's important that all participants in bidding subcontractors know whether you're expecting them to include their cost for insurance in the bid or exclude the cost for insurance. So the earlier this happens, the more communication and the less friction that's going to happen between the general contractor, the owner, and the administrator and the subcontractors along the way, because everything is clearly outlined from the beginning. Another thing that's important in administration is good enrollment and certificate collection. So you want an administrator that has an online enrollment and a database where they can store that information. It's important to have a good follow-up process, whether that's automated or, you know, it is super important just to know that you are going to have someone on the other end of the phone to help you through that enrollment process. And then having technology that's user-friendly, that allows you to collect those enrollments, collect those certificates of insurance, and helps ease the burden of the paperwork on your subcontractors and your participants. Most general contractors will even be glad that an administrator is going to collect this information for them, because it actually eliminates something that's usually part of their responsibility. And what I think it really all boils down to is communication. So you want to maintain open lines of communication throughout the job between all parties. You want to have automated reports that are going to everyone weekly or monthly, however frequently they choose, to keep everybody on the same page. It's really to get things started off on the right foot. You want to have a kickoff meeting between everyone to introduce the parties, outline the roles and responsibilities, and that really helps streamline the process and keep everyone on the same page throughout the project. Gives the sponsor the peace of mind that the OSIP stays in the forefront of everyone's mind and goes smoothly throughout.
Great. So let's discuss key takeaways from our panelists. Tanya, we'll start with you.
So look, I think the key takeaway from my point of view just is, I think it's important as the market changes that, especially in a hard market too, which we are in a hard market, that you keep up as a customer informed of the insurance programs that are available, all the options that they can bring to insure your risk. I think it's important too to make sure that you're working with vendors that are also keeping up with this, so that you can have those necessary conversations. And again, from a coverage and cost perspective, you can make sure your risk is properly covered at you know, the best financial solution. I also think we've seen a shift, which we all kind of agree on the panel, in that the multi-line wrap-up used to be very popular for many years. I think it was easier to structure. I think there were more carriers. I also think there was even the potential to use it for profit, like many owners did. Whereas I think the GLOnly wrap, looking at where the market is now, I really think is stepping up and taking its place in many instances. And I think that's why we collectively thought to talk about this, you know, subject in the presentation, and be able to educate you to know that it is available and it's out there.
Thank you. Nick, how about you? Any key takeaways from you?
Yeah, I mean, Tanya hit on a lot of them. I think, you know, especially as we see now a shift in the market to certainly harder, you know, the reinsurance market is becoming very challenging. And with that, the excess market is becoming very, very challenging. So I think with that, you're going to see a shift even to more OSIP being a path forward on projects. And that path forward on those projects is going to be attaching on smaller projects. You know, when we were looking at OSIPs a few years back, the barrier of entry was probably 75 million unless it was a condo project. And as you mentioned, Josh, you know, you're now seeing them for projects below $10 million. And we're often seeing them starting at kind of 10 million and above. And that main reason why is cost, control over the terms and conditions, you know, making sure that you're going to have that consistency, not only during the course of construction, but then through that statute of repose is really just critical for owners now, probably more so than it was before. I think that with the larger projects and the more complex they become, there has been a little bit of a different thinking from the GC side of saying, we'll just allow the owner to place this coverage and place project specific limits on this project and kind of not fight for the coverage anymore to be included in the GMP. What it really takes is buy-in from the owner, an agreement from the GC that that's going to be the process. And as I hit on before, it's really about starting early. You know, Leah said it too. It's about that communication for all the parties involved. Everybody wants the success of the project, and an OSIP is one way to help facilitate the success of that. And buy-in from everybody in that process really does help.
Awesome, thank you. How about you, Leah, from the administration side or your perspective?
Yeah, I think Tanya and Nick summarized it pretty well, but I think what it boils down to is just having a good team in your corner, having a team that's knowledgeable and experienced, and of course has your best interests in mind. And one of the main things we try to do at CR Solutions is avoid putting any undue burden on the participants. You want everybody to have an enjoyable experience and it to go as seamless as possible. So I think that having that good team in your corner is really going to help the program be successful.
Great. So we are a little bit ahead of schedule. I think I'm hearing that we did get some questions, but we're going to make sure that we give you guys a response to all those after the webinar. But in closing, I just want to thank you to everyone who joined us for today's webinar. Nick Cott, Tanya Santry, and Leah Stewart, thank you for sharing your insight and expertise. We hope this webinar has helped provide some insight into the GLOnly WrapUp product. Although more complicated than a traditional insurance placement, with the proper education, right team, understanding of roles and responsibilities, and good communication, this should be the preferred risk management product for your construction project. Thank you for joining us. Stay safe and healthy.